This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
My name is John Moffat, and this is the first of a series of free lectures working through the syllabus for paper P1. And because it's the first lecture, before I go into it, a few general points which will apply all the way through. Firstly, do make sure you've downloaded the free lecture notes that go with these lectures. Download them from Open Tuition. Because I'm going to go through chapter by chapter. I'll use the notes. There are various exercises in the notes that I'll work through to explain what's happening. So make sure you've got those in front of you. Secondly, as we finish each chapter, if you go to the main paper P1 page on the Open Tuition website, you'll find for each chapter there's a short online practice test with a few exam standard questions just to have quick practice on to make sure you were happy with what we went through. Finally, if you do have any problems, whether it's understanding anything I've said or if anything I say confuses you, it doesn't make sense, or the notes themselves, I'm not going to read every word to you, so if as you're reading you come across something you're not clear about, or practice examples or examples in any study books you've got at home, then do ask. On the Open Tuition website you'll find we've got various forums, Ask the Tutor forums. If you go to the forum for CIMA paper P1, then type in any problem and we reply. I mean, usually we reply within a few hours, but we always, unless something drastically wrong, we always reply within 24 hours. So do ask if you come across any problems. Anyway, as I said, assuming that you've got the lecture notes in front of you, I want to start going through chapter 1, which hopefully should be a nice straightforward chapter, because it's something you should have studied before, so a bit of quick revision before we carry on into newer things like chapter 2, activity-based costing and so on. It's talking about traditional costing methods. Again, later chapters will look at more modern methods. But traditionally, if we're costing, if I, for instance, am manufacturing desks, I want a cost per unit. I have to estimate how much each unit will cost to produce. And traditionally, there are two approaches: absorption costing, marginal costing. And before I quickly remind you of them, I should hardly need to ask, but even so, exercise 1 says, why do we need to get a cost per unit in the first place? Well, again, I shouldn't really need to go through this, but I think the most obvious reason of all, perhaps, is to help us determine the selling price. Help decide on a selling price. Because although there's time to be lots of other considerations, not least what price are competitors charging, there's certainly in any normal context, if it costs me $20 to make a desk, then I think fairly clearly I would want to make sure the selling price was in excess of 20. Second reason we stand to be interested is to be able to value inventories. We're making our own desks. If I've got inventories left at the end, I need to know how much each unit costs to make to be able to value the inventories. A third reason, to help with my budgeting, my planning. Talk about budgeting in a later chapter. If I'm budgeting how much I'm going to spend on wood next year, I need to have estimated how much the cost of wood's going to be for each unit. And just one more, I don't want to go on unduly, but measuring the performance of my managers. This is something, again, we'll look at in a later chapter when we look at variance analysis, which basic variances you should, again, I think have seen before. But if I've estimated each test should cost 20 to produce, if I find out it's actually costing 25 to produce, clearly something's going wrong somewhere, and we'll investigate. Am I spending too much on the wood? Am I spending too much on the labour? And so on. But it's certainly a way I can measure how well my managers perhaps are doing, something to compare with. As I say, several reasons why we're interested. Over the page, you've got features of absorption costing, features of marginal costing. Well, rather than sort of read all that to you, just let me remind you with a few made-up figures. Suppose I am making desks, and I wanted to estimate the cost per unit. I'd prepare a cost card. And I build up the costs. So conventionally, we'd expect there to be materials, the desks, obviously the wood. And I don't know, I say I'm making up figures. Maybe each desk is 2 square meters of wood. Maybe the wood is costing me $4 a square meter. So it's $8 a unit in respect of materials. Conventionally, again, as well, we need labour. Maybe we've made a few and I've been timing them. It takes 3 hours to make a desk. We pay workers $2 an hour. Again, I'm inventing figures, rather than talk blind. So there's another $6, the labour cost. In addition, we'll have overheads. We'll have variable overheads. In the factory, we're talking about production costs here. I better write in variable production overheads. So here, things like perhaps electricity for the machines. You know, the more units we produce, the more electricity we use, the more the total overhead will be. Maybe difficult to cost. We'll talk more about that in a later chapter. But maybe I've estimated that these variable overheads come to $4 a unit. So far we've got a unit cost of 18. And those costs are all variable in the sense that if 1 unit costs 18, 2 units will be 36. You know, the more I produce, the more the total cost will be at 18 a unit. And that 18 is the marginal cost. Marginal means variable. And so under marginal costing, we would value our inventories at 18, the total variable cost. However, there will be other costs involved with manufacturing. There'll be fixed overheads. I said variable overheads are perhaps things like electricity for the machines. But we'll also have other costs of production, such as rent of the factory. And the rent of the factory, maybe I'm paying $20,000 a month to rent the factory. And I'll pay $20,000 a month, however many units I produce, you know, whether it's 1,000 or whether it's 10,000, it's fixed. And so still making up figures, suppose I told you the fixed overheads, the rent of the factory, I budgeted on $20,000 per month. Well, it is a cost of production, and so if I wanted to include that in the unit cost, the problem is, of course, it may be $20,000 a month, but how much is it per unit? And in order to decide my cost per unit, I'd need to decide how many I expected to produce. Suppose I told you I was budgeting on production of, what shall I say, 10,000 units a month. Well, although we can discuss problems to do with this later, if that is the case, that I expect to spend 20,000 a month to produce 10,000 units a month, then no problem. I can say the fixed overheads per unit, 20,000 over 10,000, it's $2. And that exercise is absorbing, charging $2 a unit. And that would give me a full production cost per unit of 20, or the absorption cost. And if we're using absorption costing, again, we can discuss why not in a minute, but if we're using absorption costing, then we'd value our units, our inventory, our cost of sales, and be valued at 20 a unit. Whereas if we were using marginal costing, our inventory, our cost of goods sold, would be charged at 18 a unit. Instead of absorbing, I'm not particularly worried here, to be honest, and anyway, we'll deal with it in the next chapter. But as again, I think you should be aware, if you're making several products, then what we'd normally do, in fact, with traditional costing, we'd absorb and work out a fixed overhead cost per hour, the labour hour or machine hour, and then we'd charge it to the units, so many hours at so much an hour. Now, if you can't know what I'm talking about, I'll show you that. You'll see what I mean in the next chapter. But if there's only one product, no problem. I think it's very obvious. If it's 10,000 units, it's 20,000 fixed overheads. It's $2 a unit. Anyway, that's what we mean. As far as strengths and weaknesses are concerned, I'm a bit annoyed here. I should have set it out differently, because it's very much the case the strength of one is perhaps a weakness of the other. So rather than fill in strengths and weaknesses, first of all, let's see why we might prefer absorption costing, and then why we might prefer marginal costing. So first of all, absorption costing relates very much back to what I said earlier about the reasons for wanting a cost. I said one reason for wanting to know the costs is to help fix a selling price, and surely the absorption cost is going to be of more use. There's no point saying the marginal cost is 18, oh, let's sell at 19 and we make a profit. Of course not, because there's still fixed costs payable. The absorption cost is more relevant. I need to sell at more than 20 to be profitable. So that's one reason. Absorption costing, it's more useful when determining a selling price. The other, without going on and on because it's just not needed, but the other, perhaps most common reason people use absorption costing is although we're doing financial account, sorry, my words are going too fast, although we're doing management accounting, financial accountants, when they're producing the statutory accounts, they have to use absorption costing. It's accounting standard number 2. Now, just because financial accounts will use absorption costing doesn't mean we have to in our management statements. But clearly, there can be times when it perhaps gets a bit confusing if we're valuing inventory one way in the financial accounts and we're valuing the same inventory differently in our management statements. And so, although this doesn't have to be the case, certainly we have to use absorption for the financial statements. sorry, it may sound as though I contradicted myself. We have to use it for financial statements, or statutory accounts. What I mean is, we don't have to do it the same way in our management accounts at all. Management accounts, we do whatever we want, whichever we find more useful. So there are the main reasons why we might prefer to use absorption. I will write here though one problem before we talk about marginal. And again, it's a bit difficult. This problem is a sort of a strength of marginal. But those fixed overheads, it should be obvious where I got the $2 a unit from. But there is a problem in that it's only $2 a unit and therefore $20 in total, provided I do produce 10,000 units. Because you see fairly clearly, if we end up producing 15,000 units or 5,000 units, marginal costs, no problem. That stays at 18 a unit. It doesn't matter whether I make more or less. But the fixed overheads, if I only produce 5,000 units, fixed overheads are $4 a unit. Full cost is 22. If I produce 20,000 units, fixed overheads are $1 a unit, and so on. So that does create a problem, which perhaps is a strength of marginal. So problem is the absorption rate changes or is wrong. The $2, I'm trying to keep this brief, if the level of production changes. So that's enough there. What about marginal costing? Well, the main time this is used is for making decisions. I'll explain, let me write it first since I've started. This is more useful to help make decisions when the level of activity will change. It really relates to what I just said was a problem with absorption. Suppose we have to make decisions about how many units we're going to produce because there are various other factors involved. Maybe there's a shortage of materials or something. All things we'll discuss in later chapters, don't worry. But if it was the case that, I'd like to produce 10,000 units, but it might be more, it might be less. What's the effect on the profit going to be if it's 5,000, 6,000, 7,000 and so on? Well, I know with computers we can cope, but it's much easier manageable with marginal because, of course, however many we produce, the variable cost will be 18 a unit. So the total cost just multiplied by the 18. All right, we've got fixed overheads clearly, but they're 20,000 whatever happens. So it's just however many units times the 18 a unit, add on 20,000. Boom. It's much easier to deal with. And particularly when we come on to things like cost volume profit analysis, which again is a later chapter, marginal is much easier to deal with. Something I think is slightly less important, but even so, with marginal costing, fixed overheads are treated as a period cost. What I mean by that, think back to my example here. We said the fixed overheads I think will be 20,000 a month. Well, however many we produce and however many we sell, with marginal costing, the cost of sales will be 18 plus 18 per unit plus 20,000. Whatever happens, we'll be charging 20,000 as part of the cost each month. But that won't always be the same with fixed overheads if we're using absorption. Suppose all these figures were valid. Suppose I do produce 10,000, but I only sold 2,000. The other 8,000 were in inventory. Well, if I only sold 2,000, the cost of sales, if we're using absorption, would be 2,000 at $20, which would include 2,000 at $2. The cost of sales would only include 4,000 fixed overheads. The rest of them would be included in the value of the closing inventory. Now, you can argue all day about which is more sensible, but at the end of the day, you could say, well, I don't really care how many I produce and sell. I'm going to have to spend 20,000. Even if I didn't sell any. If I didn't sell any at all. And they were all, I produced 10,000, but they were all in inventory. Well, under absorption costing, cost of sales would be zero if you don't sell any. The 20,000 all would be in inventory. With marginal costing, right, the variable cost of sales might be zero, but you've still got the cost, the fixed cost of 20. So that's what I'm getting at. Did I actually write it down? Yes, treat it as period cost. We charge the full 20 each time. All right, that's more than enough there. Sorry going on. Finally, though, something that is quite important. The fact that, again, I think you should be aware of that already, that absorption and marginal costing, we will value our inventories different, but as a result, we will end up reporting different profits. And something that is important is to be able to deal with questions like exercise 2, where I'll read the figures in a minute, but it says calculate the difference in reported profit under absorption costing. It says in the line above that they're currently using marginal costing. Now, all right, there is a formula here, a rule. Oh, it's on the previous page. But whether you remember this or you don't, I think it's too important. I think it's too dangerous just to learn rules without understanding. If you understand, then it's an easy rule. And so, forgive me, it's the last bit of this chapter, but I am going to do slightly more than is asked, because it does put it all together and I hope revise everything. This exercise, we're told they're selling 12,000 units, they're producing 13,500 units, so the inventories are going to go up by the difference. The selling price 150, variable cost 65, fixed costs absorb at 30. Well, although this question only wants to know what the difference will be between the reported profits, it really won't take many minutes. As revision, and it does pull it all together and make sure you were clear about what I was saying before, I'm actually going to work out what profit would absorption report, what profit would marginal report. But then I will give you the rule as to how we can get the difference between the two straight away. So it won't take long, be patient. I'll do it first of all, absorption. Let's do a full profit statement under absorption costing. First of all, the revenue. We're selling 12,000 units. Selling price 150 a unit. And so the total revenue will be 12,000, 1.8 million. To get the profit, we need to subtract the cost of sales, and the cost of sales will be the cost of production less the closing inventory. Now I'm going to assume there was no opening inventory, and so the cost of production They're producing 13,500. Under absorption costing, the cost per unit is the variable 65 plus the fixed 30. So 95 a unit. So the cost of production will be 128,500. But that would be the cost of the 13,500 produced to get the cost of the 12,000 sold. We'd subtract the closing inventory. I said I'm assuming no inventory, even though it wouldn't affect things overall. But we've got closing inventory of 1,500 units. Under absorption costing, they're valued at 95. Therefore, closing inventory 142,500, and therefore a cost of sales of 114. I think the screen's not taking the pen very well. I think that's right. Is that right? 182,500. That is correct. So there's the cost of sales, and therefore the profit using absorption costing. 1.8 million less 1.14 million. I get, I think it's getting overheated. Good job, we're nearly there. 660,000. So there's the profit using absorption costing. Okay, no problem. All right, let's redo it using marginal costing. The revenue, obviously, is before, so 12,000 sold at 150, 1.8 million. The cost of sales, well, again, the production, first of all, we produced 13,500. If we're using marginal costing, we only charge at the variable cost of 65. 13,500 at 65. Can't be right. 877,500. But that's the cost of the 13,500 produced. Subtract the inventory. Again, 1,500 units in inventory. But of course, under marginal, they're valued at the marginal cost of 65, which is 97,500. Therefore, the cost of sales this time is 780,000. And therefore, the profit so far, 1.8 million less 780 is 1.02 million. And of course, this is one reason I wanted to do them in full. You should know what we call that figure. The profit before the fixed overheads, or the revenue, the sales less the variable overheads. That is our contribution. The term contribution will be vital in so many of the later chapters. However, that's not the final profit, of course, because there are fixed overheads payable. And how much were we expecting fixed overheads to be? We're going to have to work backwards. In the question, they'd been absorbed. But remember, to get the fixed overheads, to get the absorption rate, they'll have taken the total fixed overheads, they'll have divided by the production to get the $30. So that's how the 30 will have been arrived at. Well, since they were producing 13,500, the total must have been 13,500 times 30. They must have been working on fixed overheads in total of 405,000. And therefore, the profit using marginal costing would be reported as 615,000. Now again, I said at the beginning, we're doing more than this question asks. If this was asked in the exam, you don't waste time doing everything I've done. I've done it deliberately, because of revision or not revision. You know, it is important we're all clear that marginal gives us 615,000. Absorption would have reported a profit of 660,000. The two are different. And in fact, the difference, which is what this question actually asked, it was 660 as against 615. The difference is 45,000. However, I also said a few minutes ago, although you should be happy with what I've done there, if it was simply, as it's asked, what will be the difference in reported profit, you should be able to write it straight down. If I'd only wanted the difference, why are the profits different? The only reason they're different is because of the way the inventory's been valued. It's been valued at 65 with marginal and 95 with absorption. Different inventory values will result in different profits. And of course, why has the inventory been valued differently? It's because in the case of absorption, it includes fixed overheads. In the case of marginal, it doesn't. And so always the difference in the profits, it's always equal to the change in inventory in our question, although I'd assumed when I set them up opening inventory was 0, didn't actually matter. What matters is if you produce 13.5 and only sell 12, inventory must increase by the difference of 1,500 units. Well, the difference in profit will be the change in inventory times the fixed overheads per unit. And the fixed overheads per unit here have been absorbed at $30. And of course, 45,000. So please, please, please don't misunderstand anything I've done. If you only want the difference, you certainly haven't time to go through everything I did at the beginning. You can write it straight down. It's 45,000. But I wasn't doing what I did earlier to waste time. I guess I don't know about why. Finally, do appreciate that in this particular example, the profits are different by 45, and absorption gives the higher profit. And it will do if inventories are increasing. If inventories increase, absorption gives the higher profit. I'm sure you can accept, without me going through yet another illustration, that if inventories were falling because you were selling more than you produced, in that case, marginal will give the higher profit. And you'll see at the bottom of the previous page, if it helps you remember, but do be convinced, when stocks increase, absorption is more. And perhaps you could make one up for the other if you want it. when stocks decrease, margins, well, it doesn't work anyway. All right, sorry all that took a long time, particularly if it was something you remembered perfectly. The next chapter will be a bit more exciting because we start looking at new stuff. So I hope that was clear anyway. Do have a look at that practice test I referred to. Check you really have got it. And then come back whenever and we'll go through chapter 2.